I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. My position disclosure, I got out of AVGO, Meta, and NVIDIA. So I was able to reduce some long exposure today a little bit into the up move. But man, the up move, I mean, how did we finish? This market is so bad. We're trading up almost $1 after hours, still down 0.6%. The Qs are up almost $1 after hours to be about flat. The IWM is up like 70 cents after hours to be down 0.14%. So we are trading above where we closed here after hours. TLT is down 0.75%. Yeah, this is like the worst market I feel like I've ever seen in some ways. We can't catch and hold a bid for anything. I've almost never seen anything like it. I've traded bear markets. I've traded down markets. Bear markets, down markets, yeah, you know, you can have these very fast down moves in bear markets. That's like inherent in them, as a matter of fact. But you get the snapback, you get the oversold bounce, you get the lower high, you get the oversold capitulation buy to come in, and this market can't bounce for anything. CPI could definitely change that tomorrow, but these last couple days, today in particular, I mean, this is, I mean, it's so bad. And, you know, Trump's certainly not helping with his language. You know, we got a decent JOLTS number here at 10 a.m. that within 30 seconds coincided with him announcing 50% tariffs on Canadian steel that then just overrode the decent JOLTS number to hit us down again. And then, you know, him just constantly saying over and over and over again, I don't care about the stock market. Everybody expect to endure some pain. It's for the bigger picture good. Okay, maybe it is. I hope it is. I certainly hope that whatever his game plan is works out in the long run. But in the short run, he is not helping anything with these tariff policies, with policies that are inflationary, but they're also so negative growth that I'm not worried about inflation at all. It's entirely a growth story. And then, you know, you would almost expect at some point, like I mentioned in the morning meeting, like maybe with the amount of pain that the market participants saw yesterday and the amount of shouting that you're starting to see, or at least I'm seeing across like social media, even in more conservative spaces, that's turning like very, very negative. Of course, there's still supporters, but just the general outspokenness of what I'm seeing is starting to turn very, very negative on, you know, what the hell is going on with the economy, what the hell is going on with the stock market. I actually kind of thought that we would see at some point soon him support the market with words, if not actions. I mean, probably not actions yet. I still think it's going to come at some point in the future with corporate tax cuts, but at least with words. Like I bet you would see a pretty nice uptick in the market if, especially given how extended we are, if he just gave you a one-liner about corporate income taxes or corporate tax rates are coming down soon. Doesn't even have to put a date on it. Doesn't, you know, could be a very non-committal statement, but, you know, like a simple sentence like that, which I thought was the game plan to begin with, and just says soon, and who knows what soon is, next month, 6 months, a year from now. But, you know, I bet that into this degree of a down move, with the extension we have, if you had like a single positive thing come out from him, at this point, I don't think that positive statements on tariffs actually help the market because he changes his mind every other day. But something different, I think that it would really facilitate a rally. And it's borderline mind-blowing to me that the market has now gone into a correction. And it seems to me, from what I'm seeing, that sentiment towards his presidency is very quickly changing because of that. and he could just come out with a simple statement that could give the market a huge boost. I was looking for it today. I was really looking for it today. I thought we kind of hit that point where he might come out and say something. And in fact, the language that he's consistently using around, I don't care about the stock market. I'm not even looking at the stock market. I don't care if it goes down. Americans should be prepared to deal with pain, at least in the short term. It is actually it's literally the opposite. It's literally the opposite. He's further sinking down the market, and I don't understand how it's not on purpose at this point. To be totally honest, which circles back to that Charlie McElligott theory. It's the only thing to me that, like, when I first read that, I thought it was a little crazy, but it's the only thing that makes sense when you see like what his language looks like, right? Yeah, and then at some point, that's the question. When does he become the hero? It's clearly not at SPY 555. Is it 20% pullback? Is it when we're finally in a bear market, or is it just a matter of him fulfilling his stage one of government austerity that he is beginning to implement, so that he can get interest rates to be lower and the dollar to be lower, so that he can then come in and lower income taxes for corporations and wealthy individuals. I don't know. It's just crazy to me. This market cannot catch a bid for anything. I'm not even a bull. And everyone knows. I know I've been bearish for a little while now, which has turned out to be pretty accurate. But I think everyone who's been with me for a significant period of time knows I tend to be a bull, right? And right now, I'm really not a bull. I'm bearish. I like the idea of, we got to take it as it comes and see what the updates are from market dynamics and from the qualitative fundamentals and the headlines. I would love the idea of shorting a bounce back into the 570s, but the fact that we're able to stay at, I don't think I've ever seen us stay at more than $10 of extension for such a significant period of time, where it's just day after day after day after day. We haven't touched the 80 MA on the daily chart now since March 3rd. So it's been 6 entire trading sessions on the SPY of not touching the 80 MA on the daily, and honestly not even getting close to touching the 80 MA on the daily. Fairly consistently staying more than $10 extended from the 80 MA on the daily. It makes it one of the weakest markets I've ever seen. I want to say COVID was weaker, and obviously on a percentage basis it was, but just in terms of the lack of any sort of a bounce back, COVID was crazy and the market went down 30 whatever percent, but you had those huge flash snapback rallies that then got faded super, super hard on the way down, where you would snap back to the moving averages, to the 80 MA, all very, very quick with huge ranges, and then you'd puke out down on your next leg to go down 30-something percent in an extremely short period of time. And that was with the globe literally stopping, right? Everything just came to a complete and utter stop. And in some ways, I feel like the inability of this market to be able to catch even a minute bid when we're $14 to $19 of downside extension up the 80 MA on the daily is mind-blowing, because I'm not a bull right now. I'm really not. But for a tactical bounce into, we're going to have short-term tactical in the green zone again. Oh, this is interesting. So that'll be 1, 2, 3, 4. So because of this was 1, this was 2, this was 3. Yeah, so tomorrow almost definitely will be the 4th day in a row of short-term tactical in the green. I've almost never seen short-term tactical close in the green or in the red 4 consecutive trading sessions. I'm pretty sure, I think we have seen it, but extremely, extremely rare, and I've never seen it happen 5 days in a row. So if the market decides it doesn't like the CPI for whatever reason, and we get another really weak day, we'll be setting records in this down move, which is interesting because so far it's only a market correction. It's not a bear market. We're just I'm not sure if we actually closed below SPY 10% today. I know we're well below that with QQQ, but just really crazy. With that said, and I don't want to feel like a broken record on the bull side the last couple trading sessions because yesterday I was very, very wrong. Today I was less wrong, but I wouldn't call myself exactly right. I think that the risk to the CPI is to the upside, but it's a weird event tomorrow because it's like I was saying when I was speaking to Greta on Monday, and this is one of the things I love about markets. Market environments are constantly changing, and when it comes to like interest rates or when it comes to specific economic numbers, I have seen over the course of my career complete and utter flips on what was previously positive for the market becomes negative, and what was previously negative for the market becomes positive. And with the CPI tomorrow, I really don't know what to expect as far as a market reaction go. I don't know what's good and what's bad right now, which I haven't felt like that in a while. I've definitely felt like that in the past with some of this stuff, but I haven't felt like that in a while. If CPI comes in hot, that means we have inflation scares. You might even see some chatter about stagflation begin to come in. But maybe the flip side of that argument is, well, inflation came hot, so how bad can growth truly be? How bad could a GDP slowdown actually be? If CPI comes in light, then it's, oh man, things are really slowing down. So I kind of think it's even worse for the market if CPI comes in very light than if it comes in hot. It might be one of those situations where the best, most bullish number you can actually get is just a number that's in line with expectations, because then you just get the event behind you and there's nothing to read into too much about inflation versus growth. So I do kind of think that the risk is to the upside on that, partially because of how extended we continue to be. I mean, how did we close today? Right now we're trading at like 557 or a little bit under. The ADMA is at 573. So that's $17 a downside extension at the close on the SPYs. Where were we at lows today? Is that the real low? Were we really down at 552 today? We were, right? Yes, we were. So at the low we were at 552 with the ADMA at 573. That's $21 of downside extension. It's crazy. The Qs here, right now we're trading at like 472 with the ADMA at just under 490. So it's $18, a little bit less than $18 worth of extension. And the low of the day today is 467 with the ADMA at 489. So that's also, $23 of downside extension in the Qs. This is what I'm saying. We went through the entire bear market of 2022, and we never saw, we saw a couple periods where extension got this bad into the 20s from the ADMA. Like one of my favorite examples to cite was the gap down on the Russian invasion of Ukraine that really, really had us extreme. But I think we went through the entirety of the bear market in 2022 without ever seeing us stay this consistently extended. Like we did have a couple examples where we got $20+ away from the ADMA in 2022, and they were oftentimes like the ultimate buying opportunities for market snapbacks. And that's how I've been trying to position myself yesterday and today, to no real avail. I mean, yesterday I got absolutely smoked, and today, honestly, I'm kind of break even minus VKTX. I had a stock that had bad news, happens to be my heaviest position, so I got hit on that. It just is what it is. It's what happens when you swing trade positions. Sometimes you get stocks that come out and have news that's the opposite of the direction of the position that you're in. But yeah, I mean, outside of that, my P&L is very flat today, and with that, my P&L is decently negative again. So I don't know. Just a really, really, really crappy market all of a sudden these last couple days, in my opinion. There's definitely still real movements there. There's been downside momentum that traders could take advantage of. And honestly, up until yesterday, I thought that this environment was great because it was trading great. We were super on point. We were super on point with the pullback. We were super on point with each and every dip that we actually bought. Then we were super on point with the spots to re-short into those equilibrium areas on the bounces. And it's only been in these last couple of days that yesterday was clearly me making a little bit of a mistake and just being too early on the downside extension, combined with the fact that I know that the flows should be moderating. I'm not going to say switching. Switching would mean that the flows are going from selling to buying, but the flows should be moderating at some point relatively soon. So you don't have that weighing on us as much as we had up until this week. But yet we are buyers are on strike. Buyers are on strike because it seems to me that the systematic selling is less this week than it was last week, yet we're even heavier this week than we were last week. And it's just, but no one wants to touch this market right now. Buyers are on complete strike until we get some actual clarity on policy. And markets hate uncertainty. I mean, that's like rule 101 on trading in markets is uncertainty. That's the whole reason around selling the rumor and buying the news is the uncertainty can overshoot a sell-off, and then when the news actually hits, then you actually get a really big bounce back. So market participants are just screaming to get some clarity, and we're not getting any. And as a result, we just stay super, super weak. This market's an absolute bloodbath. And I can only be happy that I and as a team we were able to catch the initial short side of this move so well that it's helping to buffer some of the P&L that I've given back over the course of the last couple trading sessions. So I think that kind of covers everything I got on the macro. On the small time frame, I did nothing new today. I did nothing new. I had put on some trades yesterday that I was able to clear out of for profit, like NVIDIA on the bounce back. AVGO I got out of into its bounce back. Meta I got out of into its bounce back. I was originally looking for a little bit more in both AVGO and Meta, but I was able to sell some on the way up, and then I just decided, I'm just going to reduce some exposure in front of the CPI because I'm probably a little bit too long right now. So that is all that I've got, and I'm happy to answer any questions. Scrolling up here, I think the first thing I'm seeing is Eli's kind of comment more than a question. People keep saying, wow, traders must be having a good time, which I get what they mean, but no, not really. I mean, I disagree. I get this market has been phenomenal overall for us over the course of this sell-off. And I would say, for me personally, it's only been in the last couple days that things have gotten tricky and have kind of defied some of the probabilities as I've seen them for the market, which is what it is. From Bill, have you traded the volatility swell? Volatility swell. I thought you were asking me if I traded the volatility well, but you're saying, have you traded a volatility swell? That's what they're calling this volatility move. Have I traded a volatility swell, where I assume what you mean by that is that this VIX is a grind up as opposed to a spike up, where a lot of these past moves have been more spike ups. I mean, would you consider what we saw in 2022 at certain points to be more of like a volatility swell as opposed to the spike ups? I probably would. We would have a weak market where we would grind our way up to SPX, VIX 35, and then we'd sell back down to VIX 20. So that seemed more like a consistent high volatility market. So have I traded them before? I mean, I think so. And I would say that overall, the volatility is treating me well. Like a lot of my strategies that I implement, where I implement those kind of cash flow strategies that I have spent a decent amount of time talking about, they do well with volatility. So really, the more volatility, generally speaking, the better. Um, but those are actually doing really really well. The amounts that I'm making from them are higher than what they normally are because volatility has increased. I've just been getting hurt a little bit these last 2 days on the directional portion of the trade. But the intraday movement on the trade, I mean, I'm so busy. I'm trading so much, so many executions right now, and that's because like I feel like I can't step away from my computer for more than 30 seconds because all of a sudden it costs me money because there's a movement that I wasn't capturing properly because I had stepped away from the computer. Whereas in a normal environment, midday trading comes around. If I have to step away for 30 minutes, it's not a big deal. It's not going to cost me basically anything at all. But in this environment, it's like I literally feel like I just can't step away for 30 seconds at any point in time. Appreciate it, Bill. From Pete, you mentioned this morning that you don't use stops that much. So how do you manage risk, alerts, and if so, how do you get them in the system, or do you have them on another source? So I do use alerts, not necessarily for risk management, but I do use them. Trading software I'm on, which is Lightspeed, it's pretty simple. If you just press, for me, Control A, I can put an alert out. So I could put an alert at 556, press Enter, and if it gets to 556, it'll trigger. I know you're not on Lightspeed. I would assume that your software has a way to add alerts, Dash Trader, but I don't know because I've never used it. But you can find that out by asking DAS or asking the trade support team, and they should be able to assist. I just manage risk through math. If I have a position and it's moving against me, I don't necessarily have a stop loss out, but I know what I'll be down in any worst case scenario at any price that a stock is trading at. And I make sure that I'm comfortable with that price. And I have systems in place where basically, like on almost any long trade I have on right now, I'll make money if the stock goes up. I'll make money if the stock goes sideways. Even if the stock goes down, I'll lose money. But if there's a lot of movement on the way down, then it'll reduce the amount of risk that I originally had in the position. So if I was long, I mean, AMD is a perfect example of this. I'm long AMD. I don't even remember from where, $120 or something like that. I'm $25 against me in the position. I had a number in mind that if the stock got down to $100, I knew I'd be down X amount of thousands of dollars, and that would be where I would plan to take the loss. When AMD got to $100 and I looked at my P&L on the name, and I know because I literally just did this over the weekend, I just went through all my numbers over the weekend, I was able to see that the amount that I'm down at AMD basically at $100 is less than half actually of the original risk that I was taking of being long versus $100. So what I'm choosing to do, instead of stopping myself out at $100, is I am giving myself the extra dollar amount that I was willing to lose in it anyway. So, whatever, I'll make up a simple number. Let's say I planned on losing $10,000 on this if it got to $100. And then when it got to $100, I saw that I was only down $5,000 in it. So I said to myself, all right, I was willing to lose $10,000 in this to begin with. it's down to where I thought I would be down that amount, but from all the movement and how I traded it in the meantime, I'm only down 5. So I'll give myself the extra 5, and I'm just going to stop myself out when I see that I'm down, 10 grand in it. So the stop loss, even though I never had a physical stop in, is supposed to be $100, but now I'm just giving myself the extra room on the dollar risk to begin with. So that's kind of how I manage risk. I know that the longer that I can stay in a position, no. I know that the longer that I can stay in a position, the more P&L I'll be able to bank in it. And that's just a rule for me, basically, with the way that I trade. So, yeah, and no, I'm not offsetting with options positions. I've traded 0 options in AMD on the way down. Most of the time, if I'm putting on an options position, it's an outright trade. Yeah, I mean the volatility pays me. I mean, you can just see. You can use AMD as an example and look at my chart that has some executions on it. I have a fairly conservative game plan in AMD compared to some of my other trades that I have on, but the green dots are buys and the red dots are sells, and I bought here and I sold here and I made $1, and I bought here and I sold here and I made $1, and then I bought here and I sold here and I made $1 because I've been doing $1 increments basically with the stock, and I bought here and I sold here and I made $1, and then I sold what I bought over here and I made $1, and now all of that P&L, just assume for a second it's 100 shares every time I'm doing that, so it's 100, 200, 300, 400, 500. That'd be $500 that I banked in it, and that $500 then goes to offset towards the $10,000 number that I was originally saying. So I think I was locked out. My lockout was triggering at a certain point today. So that $500 goes towards the, if I had if I'm willing to give this $10,000 worth of room, like now that is $9,500, or it means I can give an extra $500 worth of space on the downside till I'm actually down $10,000. So basically, by doing that since 120, as it's gotten down to 100 instead of being down, and again, I'm just using these numbers as examples. These are not the accurate numbers. Instead of being down 10,000, I find myself down 5, and I'm willing to stick with it. And if a stock just decides to go sideways between 95 and 105 for the next month, I'll probably end up back positive in it without the stock even moving up, because I just continue to do what I just showed you that I'm doing. So I think that answers the question. From Dave S., any thoughts on the afternoon Ukraine headline? I actually thought it would boost the market more. I just feel like with this degree of downside extension, any incrementally positive headline that we can really get that could stick could boost us more. And I guess I just answered my own question on why it didn't happen. The market's probably not convinced that it sticks, because why would it be? And I also don't think that there's a huge amount of downside still priced in on Ukraine. There was in 2022 when it first broke out, and then as things happen in the market when it comes to news, and maybe we're almost starting to see this a little bit with tariffs, sometimes eventually the market just gets jaded with an event, and eventually it just realizes that the world is moving on with the new normal of Russia and Ukraine at war. So there's not really too much upside in de-escalation, and there's not really too much downside in further escalation, provided that, of course, it doesn't go nuclear or something like that. Then there could be a lot of downside real quick in it. But I don't know how much upside there is on the war actually ending for the market, to be totally honest. Um, the big upside for this market right now, without a doubt in my mind, is Trump waking up tomorrow and saying, you know what, I decided I'm not going to do tariffs because I took an economics class and I learned that they're bad for the economy. Um, so we'll see if that happens, but it doesn't look like it. From Keen, how much do you think zero DTEs are playing a role in not letting this market catch a bid? I don't think very much at all. I mean, we see the 1 DTE structure that Bill provides every morning for us, and those numbers haven't been extreme. I think that we were tipping into the $40-50 million mark. But I actually think that, well, it's a good thing to pay attention to. I think especially with the way the market's been trading recently, any zero DTE hedging is overwhelmed by all of the other forced flows that are in the market right now. The thing about zero DTEs is that, sure, if you put the trade on, there's a market maker on the other side, he has to hedge it, but he only has to hedge it for the day, and then they're done. So I think very minimally. From Eli, would you like to see a gap down so we can trap shorts and finally catch this snap rally? I mean, how much more trap can we get them? I would have said that yesterday. I would have said the same thing today, and we can't get the market to snap back. So at this point, no. I actually think that the best way to be able to trigger a rally, and this is kind of a little bit of what I was looking for today, but we didn't get it. I actually think that the best way to trigger a rally is to make the market move up in such a way that no one's actually able to get stock. And that could happen via a large gap up. That could potentially happen via a CPI move, because CPI is pre-market, and it could happen very, very, very quickly. Where just, I mean, I'm not sure. I think we're pricing in a pretty big move tomorrow. I don't remember how much. I thought I saw with the Qs we're pricing in like a $10 move tomorrow. I need someone to fact check that. But I almost feel like the best way to trigger a rally is CPI just causes us tomorrow to open up at 478, 480, and then no one is able to get stock who didn't already have stock suffering into this down move, and then everybody else is then forced to chase to that upside or forced to get squeezed out of those shorts. I actually, I love the RDR concept. I don't know how much more there is for us on an additional breaking of today's low to give a snapback when we just did that the last couple of days in a row and there was no buying to be found. And a lot of the positioning, at least I think in the short term, has gotten a little bit run out of the market. From Cody, what do you think of Penn? Penn's been getting destroyed. I got a great price on the RDR. Oh, nice. And I would like to target the ADMA on the daily, or maybe even $18, depending on what comes first. I like it. Look, you could show me almost any chart right now that's extended the downside, and I like it for a snapback to the ADMA. Penn's not necessarily special. I have been thinking a little bit with a couple of names that I'm in, like a Penn or like a TTD, which is advertising, where these businesses are more like impacted by like recession fears and stuff like that. I think that if all of a sudden people are strapped for cash, they're gambling a lot less. I think that if all of a sudden companies are strapped for cash, they're advertising a lot less. So, thinking about that a little bit when I'm looking at certain positions like Penn and TTD, but I still think that all of these are due for snapback. This TTD is a really good company. It was expensive at $140. At $59, it's honestly still a little bit expensive. But you're telling me this thing gapped to 85, has traded to 59, and hasn't touched the ADMA on the daily a single time in that entirety of that move? And this is what I'm talking about. There's so many charts out there that's like, it's like I mentioned with IonQ this morning, which is one of my long ideas for today. I don't like this company. I don't like the idea of really being long quantum, but when some of this stuff hasn't even touched the ADMA on the daily since mid-February, I think you could get really good snapback trades at some point in these names. Ion Q, snap back to 22.50. OKLO was what I was looking at this morning, and I guess it's had a decent day today. OKLO, snap back to $30. Not necessarily bull in the company, but I'm pretty sure it's backed by Sam Altman, and the stock just went from 60 to 24 in a very short period of time. And we can't get an extension snapback rally to 30 off that. It should be very, very possible for all these things to bounce back. But it's like, we literally had a catalyst today with that JOLTS, and immediately after, they announced that he wants to do 50% tariffs on Canada and just crushed any potential squeeze that could have come off that JOLTS number. Just kind of wild. From Shoaib, TQQ weekly chart. This is the 4th consecutive week of decline. I'd rather look at QQQ than TQQ, but okay. Currently testing support around 59. I don't like support levels on leveraged ETFs. I think that you want to look at support levels on the QQQ and just know where it's going to be coinciding with the TQQ when it gets there. Like when I trade TQQ, I really don't look at the chart of TQQ. When I trade TQQ, I look at the chart of QQQ on every time frame, even as I'm trading it, because this is the underlying. This is what the levels are. The levered ETF levels get skewed because of the effect of decay on any sort of levered ETF. But anyway, I'll take a look at what you're talking about. TQQ currently testing support around 59. If it breaks, that would be the probability of testing lows at 48. Going back to the week of 8.5 and 4.15 of 24 before bouncing back. Is there a way to calculate that probability? Please share your thoughts. Yeah, again, so I would just look at QQQ. Yeah, so I mean those are support levels. They're very far away still. I mean, I think this is a weekly chart. We would be in a bear market on those tests. But if you look at TQQQ, because of the decay, this is what decay does. You got these two lows is equal. As a matter of fact, it looks like the August low is slightly below the QQQ low. Sorry, did I say that right? The TQQQ low in August is lower than the TQQQ low in April, whereas on the QQQ, the low in August is higher than the low in April. I want to pay attention to this, not the TQQQ. That's all. We were talking about this in yesterday's afternoon meeting, and I think someone in the VTF, might have been Bill, posted a chart of the VIX ETN's decay, which was kind of interesting to look at, like day-to-day decay, I think it was. And it just shows you why all levered products are garbage for more than just a trade. So look at QQQ, not TQQQ. That's my feedback for you on that. And the QQQ levels are still very, very far away. All right, cool. We got through the VTF. Take a look at take a look at the YouTube here. Yeah, Liam just making a commentary on what I was saying earlier about it seems like he's losing some of his base support because of what the market's doing, and kind of saying that he's seeing the same thing. From Steven, would you rather see CPI be in line with expectations or slightly higher than expectations so growth isn't scared? It's like I was saying before, on this CPI, I'm very uncertain on what the reaction looks like. I think that you want it to be generally closer to expectations, is what I would think, than a far reach. A far reach in either direction might end up being bearish, whereas a more inline number might be the most bullish situation. I'm sure tomorrow we'll get some data out from the sell side on their expectations on what, if CPI hits certain points, what the market should do. Granted, they're not always right either. They're fairly wrong. I'm pretty sure they were pretty wrong on the last CPI. From James, if CPI is higher than expectation, that indicates inflation. Would you expect all those people who are sitting on massive cash reserves start to reinvest to protect against inflationary losses. It's good. It's a good thought process. But the read through, like I keep saying on the CPI, is a conundrum to me, because if CPI comes in hot, yeah, it's inflation. Maybe they reinvest. But is it stagflation, which is the worst thing possible? I'm not ready to jump to the conclusion of stagflation on that, but certain market participants might be. So yeah, we'll see. I think, generally speaking, a hot CPI will be better than a really light CPI for kind of the reasons that you're describing. But let's see what happens tomorrow. From Steven, what cash flow strategies are you trading during this volatile period? It's just the same stuff I'm always talking about. Just you know, I'm not going to be able to give a full detailed explanation of it in today's afternoon meeting, and I've done it on a bunch of afternoon meetings in the past. It just takes a lot of time, is the reason why. Not that I don't want to answer your question, but it's kind of like what I was describing with AMD earlier, where I have a set amount of risk on the trade, and if I'm risking $10,000, and every time I get a $1 movement on the trade, if I'm able to, buy and sell 100 shares, that's $100. So I do it one time, I reduced my risk from 10,000 to 9,900. Or do it a second time, I reduced my risk to 9,800. In this case, 5 times, I reduced my risk to 9,500. And I describe that as like a cash flow strategy. In this case, I'm talking about risk. In another case, I have a position that's working out really well for me. I'm $10,000 in the money, and then this happening today just means that I'm $10,500 in the money instead of 10,000, and that extra 500 is just cash flow from the strategy of working the position back and forth. Totally off topic, but what are your thoughts on DraftKings? Sure. Very similar deal here. Very similar thought process as most of the other growth names that we could take a look at right now. Was probably a little ridiculous at 54. It's probably a little ridiculous at 36. I think most of these names could use a snapback. DraftKings actually gave a better snapback than probably most other names that are out there. But I think that there is room for a decent snapback in a lot of these growthy stocks. From Formula One, I like the idea of looking for a snapback and potentially keeping some longer if we get a prolonged move to the upside. If there is still a correction in a bull market, if this is still a correction in a bull market, then the risk reward here is hard to ignore. I agree with you. And that's been one of the big debates. Is this just a correction in a bull market, or is this something new? The 200-day pointing up would indicate that this is just a correction in the bull market. But every bear market started with a correction where the 200-day was still pointing up. Historical probability perspective would indicate that there's a higher probability that what you're describing is correct. This is a correction in a bull market and not the start of a new bear market. I would argue that the nuances of some of the qualitative fundamentals point towards this becoming a higher probability of a true bear market than otherwise, but it's hard to say. I always want to start with the retracement trade and then have rules in place for how the retracement can become a reversal. For the moment, all I'm looking for is the retracement trade. And when it gets there, then I'll reassess what the probability is of this retracement up becoming a full-on reversal versus this retracement up being creating a pivot high, and then that pivot high is potentially shortable. From the one saying, just because it didn't happen the last 2 days doesn't mean necessarily that it won't. 100% agree. 100% agree. It still very much could happen that we could get the correction. We'll see what the CPI does tomorrow. I'm of the thought process that this degree of downside extension cannot be sustained, which is why my mind is blown that I'm doing an afternoon meeting today where I'm looking at $23 of downside extension again. Really kind of blown on that. I don't think that this degree of downside extension can last. To me, it's more a question of what is the correction look like? Like, I am looking for, a lot of people are looking for a price correction. What if it's time correction? And I'm looking for a price correction, but I'm also game planned mentally for the possibility of it being a time correction and what I'm going to do in that situation. And it just means I'll definitely be making less money on the bounce back. From James, Trump seems to be using tariffs as a retaliatory weapon, sometimes against tariffs on us, others on policies like fentanyl. The retaliatory tariffs on Canada already proving effective results wise. Yeah, I'm just gonna say what I've said in the past about this. There are arguments to be made that there are other benefits from tariffs that maybe even make up for causing economic pain like it is. I am not a politician. I am not going to opine on things like fentanyl or the potential importance of tariffs for national security. I am going to keep my opinions to markets and economics, and we've got several hundred years of data that show that tariffs are bad economics. So, that's really the extent of my thought process on it. How much of the market dropping due to tariffs is because of investor sentiment and fear versus actual market damage? It's market damage. It's market damage. I mean, GDP estimates are coming down. I mean, it's very, very, very clear and obvious to me that if he were to actually continue to push through, I mean, I still think, and I think I actually think the market should be down significantly more if these tariffs are real. I think that market participants, and this includes me, are still pricing in that all of this actually is to some degree a negotiating tactic, and that the tariffs are going to get pulled back on. Otherwise, we would and should be trading significantly lower. And so that's the big question. We like if we actually were to do 25 to 50% tariffs on our top trading partners, there's no way that we don't go into a recession, in my opinion. Like, absolutely no way. But I still think, and the market participants still think, that it's a negotiating tool. And maybe we have them on for a month or 2 months or whatever, and maybe it's related to fentanyl and everything else, and then they get pulled back, and Trump looks like he did something really good, and we endured some short-term pain to make it so that drugs aren't coming across the border or whatever it is. Again, outside of my salary range on that, but that needs to happen. Otherwise, we're going lower. Plasma Lab saying, look at the tariffs that Canada and Europe has. Why is it not bad economics for them? It is bad economics for them. It's very simple. This is very simple international economics. And I think I just went over this yesterday. If Pete is really good at making corn, and he can do it better than I can, and I'm really good at, I don't know, making cups, and I can do it better than he can, he should make corn because he can do it better and more efficiently. I should make cups because I can do it better and more efficiently, and then we should trade. And when you do that, you get a larger sum of total goods for a cheaper production price at the quality that is best because it's produced by the participant that can actually make it best. I've seen a lot of the argument of like, well, they have tariffs on us, so we need to have, honestly, and I'm looking at Canada with what Canada's doing on them, doing retaliatory tariffs on the U.S. because Trump's doing on them. I think that the smartest thing that Canada could do would just be like, all right, you can put tariffs on us and hurt yourself. We're not going to put any tariffs on you because retaliatory tariffs are stupid. They're just going to hurt our people. We'll have our people just continue to get cheap goods from you guys. And then, then they can turn the electric off or whatever else they're talking about. So, I mean, it's really simple. I mean, there's more complexities to it that are outside the realm of markets that, again, I keep saying it over and over again. It's not for me to have an opinion on that's not going to make anybody money. Do I have an opinion on things like fentanyl? Of course I do. But I'm not going to share it because it's not going to make anybody money. Um, what is going to make people money is an understanding on markets. And you can literally see it in the stock market. Every single time that Trump announces he's going to do more tariffs, the market immediately goes down. Why does it do that? Because tariffs are bad economics. And every time Trump says, I changed my mind, I'm not going to do tariffs, the market immediately goes up, right? You know, beyond the fact that there's hundreds of years of data that support what I'm saying and its logic and everything else, the market is showing it to you in every uptick and downtick when he comes out and says it. So, you know, again, I have the opinion that if other countries want to hurt themselves by having tariffs on, like, us as an example, that's their problem. I don't need us to hurt ourselves by doing the exact same thing. And, you know, look at exactly what's going on with the market every single time that happens. So, Josh, please. Josh voted for me for president. Always worth bringing up this scenario. United States grain embargo against the Soviet Union per Wikipedia. Cool. Worth taking a look at. Thanks, Tate. Derrick, I mentioned this before. Yes, I mentioned this morning. Historically, extremely low, assuming probability, would mean 3 bear markets in the past 5 years versus the norm of 1 every 5 to 6 years. Has there ever been 3 bear markets in a 5-year period? I don't know. Ask AI. I always like to pay attention to those types of statistics, but you got to take them with a huge asterisk and a huge grain of salt, because what has happened in history in terms of bear markets over a certain period of time, you could always be looking at the environment where it's the first time that's different. I think that the yield curve inversion was just an example of that, when we had a yield curve inversion a few years ago that did not lead to a recession, and even the person who originally came up with the yield curve inversion indicator or whatever was saying at the time that he thought that this time was different, and then of course it was. With the emergence of AI, how much are you looking to data warehouse energy companies and industries associated with massive amount of compute needed to train these models? I mean, I trade them. I did really well shorting OKLO. I mean, you know, the AI is the big theme, right? We want to pay attention to that, and it's constantly updating. And then when DeepSeek came out, all those things took a really big hit because all of a sudden you didn't need to use as much potential electricity to be able to do that. Or maybe you do because there's a knock-on effect of it further accelerating the growth of AI, so it's hard to say. So I definitely look at all those companies. I trade a lot of those companies, but I trade them on both sides. There was, you know, a great short in this OKLO up in the low 50s when I was putting that trade on. And now down here, I actually called out OKLO in the morning meeting today as a long. And it worked okay today without the market, let alone if the market actually could have helped this stock, it probably would have given a much, much bigger bounce. So yeah, definitely pay attention to them for sure. All right, I'm exhausted. I started my day way too early today. I was dreaming of trading Tesla, and I woke up at 1:45 local time, which is 3:45 Eastern, and decided to start my day because I knew that by the time my coffee would be ready, that the pre-market trading would open up, and I had a lot of longs on, and I knew we were probably going to gap up, and I wanted to position myself for them. But I got up way, way too early this morning, and my day has been long. So I am going to rest up tonight and try to get a good night's sleep because we got CPI tomorrow, and that's all she wrote. So have a great night, everybody. See you then.